Thanks for joining us today on The Close. Markets close in a half an hour's time. Let's get to the stories we're following out of the BNN Bloomberg newsroom. Just coming into the newsroom, Algoma Steel laying off 1,000 workers. 1,000 workers have received layoff notices. The steel maker is based in Sault Ste. Marie, Ontario, but its business has been under incredible pressure because of Washington's 50% markup on steel, which has made it virtually impossible for the company to send its steel south to get paid. So Algoma laying off 1,000 workers, that announcement just making its way into the newsroom. Barrick Mining says it's exploring an initial public offering of its North American gold assets. If that goes ahead, the spinoff would be anchored by Barrick's mines in Nevada and the Dominican Republic, and Barrick would retain a majority interest in a new entity. There are reports Barrick is being pressured by investors to shake things up. Shares of Shopify under pressure today. The e-commerce giant experiencing a widespread outage. Some merchants are having trouble accessing their point-of-sale systems. Shopify says online store checkouts are not affected, and it's working to resolve the problem. Also, Oppenheimer's Ken Wong said Shopify's $6 billion in merchant sales for the Black Friday promotional period came in below what analysts were expecting. Shares of Transat are trading higher. The airline and tour operator company confirmed it has a request for a special shareholders meeting from Pierre Pelledeau's firm. His firm is calling for changes to Transat's board. There have been calls for restructuring as well. Transat says its board has a clear and disciplined plan for the company. Let's get to where we stand on the North American markets right now. The TSX has a 237-point drop to start the week. It's at 31,145. South of the border, the S&P 500 dropping 31 points. The Dow Jones, a 352-point drop. That's about 0.75%. And the NASDAQ, an 88-point drop today, about 0.4%. Markets on the decline to start the final month of the year, and the flagship cryptocurrency Bitcoin falling below 86,000 US today, adding pressure to stocks. Let's go to Pierre Ouimet. He's head investment strategist at UBS Canada. Pierre, thanks for joining us today. How do you think equity markets will end the year?
Well, probably somewhere around where we are right now. I think you look at the economic backdrop, it's not particularly buoyant, although the third quarter was strong. I think you'll see a relatively weak fourth quarter and maybe kind of a little bit of the same in the first quarter, which is not exactly going to prompt people to push ahead with risk assets. But beyond that, I think the coast is clear for markets to continue to rally through next year. There are a lot of supportive elements out there.
Okay, how do you think the AI story will evolve next year?
Pretty well the same. I mean, more and more spending. It's revolutionary to a large extent. We don't know how much in terms of productivity gains we're going to get. We'll have to wait probably a few years in order to see that. We don't know what's going to happen either on the employment side. How many jobs will be eliminated? How many new jobs will be created? Most of the proponents of AI are saying that we'll be surprised by the amount of new jobs that are created. Well, surprise me. I'm willing to be surprised, but I think it's going to be difficult in terms of employment going forward as well, in terms of increasing employment. Obviously, on the manufacturing side, there's a lot of hope that there's going to be a lot of growth in employment there. We have our reservations about that, but on the service side, we could see further gains.
Okay, because of the many unknowns that you have listed, would you reduce risk to tech stocks at this point?
No, we're still relatively positive on tech stocks. The main reason, of course, is earnings, and for that matter, we're positive on equity markets as well for the same reason. We're seeing earnings growing right now at 8 to 9%, and probably by mid next year, year-over-year growth rate in earnings is going to be double digits, probably in the low teens. And that should help sustain equity prices going forward. We think the U.S. economy will rebound in the last three quarters of next year, maybe even in the first quarter relative to the fourth quarter of this year. And there's a fiscal bonus to be had next year as well, deregulation. There's going to be a lot of fixed asset investment, particularly in the manufacturing side, which will probably initially show up in construction jobs. But, definitely there are a lot of positives on the horizon for the U.S. economy. We're not talking about going to 4% growth, but clearly rising above 2%, 2.5%, or maybe even 3% growth going forward. And the U.S. consumer, I have to admit, the low-income consumers are stretched. But you look at the wealth effect, and the top two quintiles, or the top 40% of income earners, particularly the top 20% of income earners, are just continuing to spend. So that helps sustain the consumer spending. And then last but not least, you have a supportive Fed. Interest rates are likely to decline next year. We expect the Fed funds rate maybe to reach as low as 3.25%. And that will be supportive for equity markets and risk taking.
We have Canadian banks who will be reporting. What do you expect to hear?
Overall, we expect some relatively good news, mostly from better net interest margins, probably, depending on the bank, lower loan loss provisions, and also heightened activity in capital markets. So it's likely to be a relatively good quarter for the banks. We'll probably expect more follow-through of that next year as well. Now, the Canadian banks that have operations in the U.S. as well, they're facing less of a regulatory burden, and that should help the likes of BMO, TD, even Royal Bank for that matter. So, the outlook for the banks continues to be relatively good.
Are you looking outside of North America to put money these days? If you are, where are you looking?
Well, we've already diversified to Europe, mostly on the significant change in the fiscal situation in Germany. Lots of money, lots of government spending going into infrastructure and defense as well. And that's definitely going to help the European and the Eurozone economy in general. We diversified also to Japan, but we're also looking at emerging markets as being relatively attractive as well. We don't necessarily think the U.S. dollar will. We're not necessarily that positive on the U.S. dollar, although we don't see it really declining significantly. But as rates decline in the U.S. and the spreads narrow, I think the path of least resistance for the U.S. dollar to go down. And I think that's going to help emerging markets as well, where the earnings are quite strong. And actually in Canada, I mean, if you look at it from a global investor, I guess they're looking at Canada, and really they haven't, global investors not really interested in Canada. But I was looking at the earnings revision ratio the other day, and Canada actually, of all the countries in the world, is one that has the highest earnings revision ratio. And a lot of what drives earnings in Canada has very little to do with the domestic economy. So I would suggest that for foreign investors to look at Canada as a possible diversification.
Got it. I do have to leave it there, Pierre, but appreciate you joining us on The Close today. Pierre Ouimet is Head Investment Strategist at UBS Canada. Coming up, an activist investor seeking a shakeup at Transat. More in a moment. Shares of Transat trading a little higher today after activist investor Pierre-Carl Pelado demanded a board shakeup and strategic overhaul of the travel company. Mr. Pelado joins us now. He's also the owner of Outremont. Thanks for joining us today.
Yes, good afternoon.
So I know you've requested a meeting of the board, and the latest date you want for that meeting is February 6th. Have you heard from board members? Have they responded to your meeting request?
Not a board, a special meeting of the shareholders to discuss the board composition. And, reducing it from 11 to 6, we're talking about a company that have a market cap of $80 million. And I think that at this stage, regarding the balance sheet and the situation of the company, it will be worth much more, to invest in the business, and instead of, investing at the board of directors and everything that goes with it. So then, therefore, given, and I've been there for many months, even many years now, reviewing what was the strategy of the company, and we're forced, to conclude that right now everything that had been taken by the board had been mostly a failure. So the balance sheet is broken. We need to fix the balance sheet, because they will not going to take any other investment will take place without making sure that, we're going to arrive at the first base. It's like a baseball game, If you want to go at the second or the third base, you need to go to the first. And the first base for this company is to fix the balance sheet.
Okay.
It's completely the opposite of the industry. It is the worst balance sheet that you've seen. And then, therefore, if you don't fix it, you run the risk, to get this business out of business one day or another.
Okay, so let's talk a little bit about support. There are 11 board members, I understand. You want to take it down to 6. You want to be on the board. Have you been talking to other shareholders or board members about this? What kind of support have you had?
Yeah, we've been talking with other shareholders. I think that, we're completely aligned. Every shareholders would like to see, this business moving forward successfully. There's 2 large shareholders. One is la Caisse de dépôt, and the other one is the Fonds de solidarité de la FTQ. We've been in discussion because, again, everyone believes this company have a very strong brand. They've been at the heart of Quebecers for so many years. This business is in the right position or in the right industry because it's a growing industry. We all know that life expectation brings people spending more, traveling more. But you need to have, the proper strategy and, again, the proper balance sheet to be able to succeed.
That being said, they have made some progress on paying down their debt. It was $800 million a year ago. Now it's under $400 million, or at least it was by end of summer. I believe that was beginning or end of July, beginning of August. So they are making progress there. You think you can make that situation come about more quickly, cutting the debt more quickly?
The debt reduction comes from a write-off of the largest creditor, which is, the government of Canada, that had been helping the company during the pandemic. Today, you're in front of quite of a situation of a kind, I would say. Here's a company that is major creditor is the government of Canada. Here's a company that the largest shareholder is the government of Canada. And here's, a company where the regulator is the government of Canada. So how can you really, believe in the future of the company if you sit on different seats like this? And one day, you'll be for the red, and the other day you'll be for the blue. That doesn't make sense.
Okay. So you want to cut, sorry to interrupt you. I'm running on limited time. You want to cut the board, which will cut costs, but how else would you reduce debt for this company?
Yeah, again, we need to restructure the balance sheet and then therefore, sit with the major creditors and making sure that, we'll be able to find the proper balance of debt and also in terms of cash injections. Because today, any dollar that will be invested in the company will go directly, reducing the government of Canada debt. So you cannot ensure the viability of the company with that kind of conditions that you have right now. If you want to succeed, then you need to make sure that you will invest in the company, invest in the product, invest in the customer service. I use the example of Videotron that had been very, very successful since we took over in 2000. It is the company that had been able to invest in wireless. We grew significantly there. Customer service, we have the proper balance sheet. We've been investing in the proper places. And this is what we would like to do with Transat. So, again, illustrate it, with what we've been able to do.
Okay.
We're in front of the company where the board was incapable of moving the needle. It's been there. We're facing a failure, and then therefore we need some significant changes. And this is what we're proposing down the road.
All right, Mr. Pellado, we will leave it there. I'm out of time. So thank you for your time. Appreciate you joining us on The Close. Keep us up to speed.
Thank you very much.
Barrick Mining exploring the launch of a new IPO for North American gold assets. We'll talk about that when we come back. Barrick Mining is exploring the launch of a new IPO that would spin off its North American gold assets. The proposal would separate Barrick's prized North American operations in Nevada and Dominican Republic from some of its riskier assets in Africa and Pakistan. We sit down today with Martin Pradier, equity research analyst at Veritas Investment Research.
I asked the CEO at some dinner that analysts had, and he was not in favor of this, but obviously I think things have changed. The Elliott management position is very large, and usually, they put pressure, and this is probably a response to that.
Is that the biggest thing then? Elliott, what do they own? I think they own
like a billion.
A billion, yes.
So, somewhere like that. We don't know. The board has decided this, so this is going to move forward. I don't know exactly how did play out. But obviously, when you have a very big active investor, that puts a lot of pressure on management, and the stock has not done well for a while, and that the separation might show a better valuation for the North American part, and that might help the stock overall.
And when they say they're exploring, does that mean that probably it's going to happen, or is it really just they're exploring and it may fall apart, there may not be anything?
I think it will happen. I mean, I don't know, but
Yeah.
but I don't think you go out and put this kind of press release if you don't think there is a very high probability of this happening.
And fairly quickly, or will it take a while, do you think?
They said that we're going.
If it goes through,
they're
of course.
going to update the market February 26 when they release the results. So I think it's it's fairly quickly. I mean, they're going to update you, and by the time they update you, it's probably they already have a plan of when this is starting trading and all that kind of stuff.
Is this really the only way they could go about it, was dividing it North American and world?
Probably. I mean, it's easier for the market value to value the North American assets higher if they are not with all the other assets, which have a much higher risk. So, yeah, I always thought that if they're going to divide, this was the kind of division that they will do, because that's where I think they can generate more value for shareholders.
And who will show interest in this? How do you see this unfolding? Who do you see the buyer, like people wanting to get in on this, on the new company?
Well, there are a lot of investors that would be interested in this. It's going to be a cleaner company. The only problem is the Nevada operations hasn't done well for the last 4 years. So for the last 4 years, the production was down 23% from 2020 to 2024. Costs were up 45%. You compare that, for instance, with Agnico, that cost only increased 13%. So they haven't done as well. So the priority for them is to fix Nevada, and then they can have more value. So this is probably a good way to start. But to really see the value of Barrick coming through, you have to be able to demonstrate that, Nevada is a fairly low-cost producer, as it was in the past, and it can grow.
And do you feel they can do that? Do you feel There's the
Yes,
everything's in place for that to unfold.
I think there will be more focus, and hopefully they can do it. For Mill, that is, the big project. If it happens, and it probably is going to happen, it's 2029, 2030, that will reduce the cost of production a lot because it's a much higher grade. So that will reduce the cost. And you'll see more of the impact now because you don't have the rest of the operations. So on a smaller overall entity, that lower cost will show itself better.
Now, what happens with the other operations? Where does it leave that?
I mean, Barrick will be still trading, so you can buy the whole company.
But can you see people moving away from it, though, because it's now more high risk than when you had the North American operations?
I see them moving away, for instance, of Mali, where they had all these problems, and the rule of law is not very good. So if they were a buyer, I wouldn't be surprised if they move away. But the rest, they're probably going to keep it, I think.
But what about can you see investors shying away from Barrick if it's just the world operations, or will they?
Well, the way it's going to be structured is Barrick will still be trading and will still be owning the majority of this new IPO company. So the mothership is going to still be the Barrick that you know.
Yeah.
The only difference is now that you have a clear indication of what is the value of North America, and on top of that, the value of the rest. And if the value of North American rises a lot, people are going to assign more value to the overall Barrick. I think that's really what they're thinking.
And can you see Newmont maybe getting into this somehow?
Well, this is the part that Newmont will be interested. Certainly. I mean, Pueblo Viejo is a partnership, and Nevada is a partnership with Newmont. There were rumors that Newmont wanted to buy. If they were going to buy, they were probably going to just keep these assets and sort of discard the rest. So I could see them, but Barrick has control. I mean, they will IPO a minority position. They're not going to IPO the majority. So they will have control, and if they eventually reach a deal with Newmont, that's fine.
But if the offer is right, everything is for sale, though, isn't it? You think, or no?
Perhaps. That time will tell. I mean, it's true. This is more attractive for Newmont to buy this new company than to buy the whole Barrick and then having to sell all the other pieces that they don't really want.
Martin Pradier, he's equity research analyst, Veritas Investment Research. Coming up, the closing bells on Bay Street and Wall Street. Here are the end-of-day closing bells. At the NASDAQ, Black Baud ringing the bell. In New York, CIBC Miracle Day ringing the closing bell. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX dropping 281 points today, almost 1%. The S&P 500, 36-point drop, about 0.5%. And the NASDAQ, an 89-point drop today, so about 0.4%. Let's get to the movers in Toronto. In the green today, Bausch Health gaining more than 11%, or $1 flat, coming to $9.88. That is on acquisition news. Bloomberg's Stephanie Hughes will have more on that in just a moment. Curaleaf also moving up today. It gained 4.6%. It's a cannabis company. And then Aecon Group also moving up today. It gained 96 cents, 3.5% move up to end the day 28.24. Skeena Resources also ended in the green today. It's up 3.2%, or 94 cents to 29.93. In the red today, we have Celestica. It dropped more than 7%, $34.90 loss to $445.21. And then Shopify down. It's been dealing with an outage today. It lost 6.3%, or $14.11. Bombardier also moving down today, losing 4.3% or $10.10 to $221.99. All right, for more on the movers and what's behind them, let's go to Bloomberg's equities reporter, Stephanie Hughes. She joins us now. Stephanie, welcome back. Good to see you. Bausch Health, the big gain today with a Chinese acquisition. Tell us some more.
Absolutely, Morella. Yeah, so Bausch Health was by far the top performer on the TSX for pretty much the entire trading day today because of that recently announced deal that you just mentioned. I'll get into more details in a second, but that stock price move went by over 15% at its highest point. So it was quite a sizable move there, and that was its biggest gain since August. So what happened here was Bausch purchased a longtime Chinese aesthetics distribution partner, short name being Shibo Group, meeting a rising demand for beauty and aesthetics treatments within China. Shibo Group has long been the distribution partner for Bausch's Solta Medical Group business, which has some treatments like skin tightening and I presume other anti-aging kind of services. So Bausch Health CEO, the management has been saying that the impact will be immediate, with the CEO, Thomas Appio, saying that the company's medical segment will gain immediate access to a larger customer base and with it some revenue and market share growth. I didn't see a lot as far as analyst reaction coming out on this. No notes came by my desk today, but just based on that double-digit growth in the stock price, you can see that shareholders and investors are certainly reacting to this purchase, Morella.
Okay, let's get to another mover. Barrick Mining also moving today. There are reports of a shakeup. We've heard murmurs already in the past.
Absolutely, yeah. Barrick is another gainer. It's been the talk of today for a lot of us on the equities team, but Barrick moved by nearly 3%, breaking to a new all-time high throughout the trading day today. Not a huge move, but enough to get the miner breaking its new record there. And the company said it was exploring an IPO for its North American gold assets, which analysts see as a positive for shares and it would create an acquisition target for Newmont. City analyst Alexander Hacking said that this potential IPO news wasn't really a surprise to him and his team, just given the recent headlines around it, the speculation. Investors were equally divided between whether Barrick would spin off its North American assets or if it would split into two entities. So the team at RBC Capital Markets see the spinoff generating between 15 to 20% stock price upside from its current valuation, adding that Barrick has been trading at something of a discount with its sum of the parts valuation, mostly because of its higher exposure to geopolitical risks. So that's what we know so far. Right now, the company said that the board will be reviewing the potential for this IPO early next year, and the company will provide an update next February. So we'll have to wait and see what ends up coming out of this and whether that IPO kind of gets past the finish line, Morella. All
right, we will stay tuned for that. We have Bloomberg's Stephanie Hughes. Thank you. All right, let's move to movers south of the border. Bloomberg senior equities reporter Bailey Lipschultz is there. Bailey, NVIDIA has a deal now with Synopsys. Did both gain on the news today?
Yeah, both gaining on the news. So NVIDIA seemingly is throwing money around and making partnerships and moving stocks. Seemed like it had been a trend that was falling out of favor, but not so fast with this $2 billion investment in Synopsys. So further partnering with another company in the tech ecosystem. The big pitch from NVIDIA and from Synopsys here is that this is going to make potentially better, faster, quicker technology. So as you can see, Synopsys rallying today, still not near those highs that it saw in late October as part of that broader pullback that we've seen in the AI infrastructure and kind of broader tech ecosystem space. But broadly speaking, it's been a pretty solid year for the company. As you mentioned, NVIDIA had rallied as well. So positive news for both of these companies, both companies in the green, amid a relatively choppy tape. So another positive step, or at least positive data point if you're reading into investments for NVIDIA, though this is yet another example of these potential circular deals where NVIDIA is either partnering with companies or investing outright in them. So certainly something that has been a trend in 2025, and it'll be interesting to continue tracking through the final weeks of the year as well as in the start of 2026.
Yeah, and what will come of all of those partnerships that they're announcing at such a rapid pace? Okay, Bitcoin still falling today, dragging some other stocks with it. Tell us about that.
Yeah, Bitcoin under pressure again, had rallied over the weekend and really picked up a bit of steam depending on the days that you used last week around the U.S. Thanksgiving. But we are seeing weakness for the likes of MicroStrategy. We are seeing weakness for a lot of these companies that are tracking it. So as you can see, more volatility for Bitcoin back below or at least near that $85,000 level. MicroStrategy, Michael Saylor's company Strategy, which is one of the hoarders of Bitcoin, closing at or near its lowest level since last October. This is a company that had championed kind of the vision to sell stock and things like preferred shares and convertible debt to turn around and buy Bitcoin. Well, that's a strategy that really only works when your stock trades at a market premium to the Bitcoin that you hold. So that premium to NAV, net asset value that we've been tracking, was north of 2 times this time last year, now getting back towards 1. So will the company have to sell Bitcoin? CEO said, push came to shove, they would consider that, though that's not their preferred move. They did announce and kind of execute what they call a dollar reserve to help pay the coupon on some of those preferred shares. So a lot of financial engineering, financial steps around having to sell Bitcoin for MicroStrategy and Strategy right now, going to be something that we continue to track if we do see Bitcoin pulling back towards that $80,000 mark again.
Okay, let's get to Moderna because it moved down today. FDA tightening some guidelines for vaccines.
Yeah, we're seeing kind of Donald Trump and Robert F. Kennedy Jr.'s push to tighten vaccines availability and what vaccines are actually being injected into people. So we do see Moderna slipping again today. Again, this is a company that's shelved itself from back in 2021. But again, after the FDA pushing to tighten some of those guidelines, wanting to be more strict in terms of the data that companies are showing to get vaccines approved and trying to limit the amount of the population that are being encouraged and even being able to get some of these shots. Moderna has long been one of the champions that's been pushing that mRNA technology. Their entire kind of pipeline is built around it, and their entire pipeline is built around being vaccines that can treat things like cancer. So when the FDA is putting the spotlight on you or looking at some of your approved products more diligently, that's certainly going to kind of tamp some of the enthusiasm that Moderna can get back to where it was earlier this year or even this time last year.
All right, Bloomberg's Bailey Lipschultz joining us with the latest mover south of the border. Thanks for that. And coming up next, stocks have started the month in negative territory. More on what sparked declines when we come back. North American markets moved back into the red to start the new week and the new month after gains last week that took the TSX to record highs several times. Let's go to Youngyu Ma, Chief Investment Strategist at PNC Asset Management Group, to talk about this. Thanks for joining us today.
Thanks, Marilla. Great to be here.
Let's talk about AI to start. Do you see AI investing as getting a bit of a reset here?
I think we're seeing somewhat of a reset. I wouldn't call it a full-blown reset. I think right now what the market's doing is trying to sort out which investments seem sound and where there might be overinvestment, and which companies are really gaining traction in what looks to be a durable way versus which companies might have business plans that don't become as robust over the next few years. And I think that sorting is actually healthy for the markets, but it will eventually result in a reset. But I think we have more sorting to do here and probably more back and forth in the markets. Do
you think we've seen the end then of the one-day double-digit gains and losses in the sector?
It's hard to know if we've seen the end of that. Certainly, one thing that's very interesting about the sector is that so much of the benefits and the gains are out into the future, years to come, even decades to come. This could compound over time. So if there are developments or news, either good or bad, that can be impounded and priced very heavily in the short term. And so you can see big gains and you can also see big losses. So I don't think we should be lulled into a sense of complacency or even modest moves. Every once in a while, a big move is going to come by.
So when investors are looking forward, you mentioned they're sort of shaking out the details these days. What should they focus on if they want to maintain some traction in AI?
Yeah, it's an evolving landscape. One thing that's very distinctive and I think important about this technology versus other technologies that have been new in the past and prior decades is how quickly this is evolving, the AI technology, how quickly new models are coming out, how quickly new use cases are coming out. So, I think it really pays to be well diversified in the space. I do think it's an important space to have exposure to, but it's also an important space and so fast moving of a space. It's hard to stay abreast of all of the day-to-day, week-to-week, month-to-month developments unless you're really devoting a lot of effort to it. And being diversified within the space makes a lot of sense too. There are going to be many winners. That's good to know. Exactly who the winners are, which is those that ultimately fall behind. I think if we take a lesson from the 1990s and 2000s, some of the companies that we thought were going to be early winners in the late 1990s turned out not to be winners. And some companies we hadn't even heard of in 1999 turned out to be huge winners a decade later. So it's important to be diversified in the space.
What sectors do you see already benefiting from AI rollout, the use cases?
Well, I think some of the sectors that can benefit very importantly in the economy are the healthcare sector, for one. Now, of course, there's a lot of practical implications of how that gets rolled out and which areas it gets rolled out. But I do think that some of the early indications for how AI can benefit the healthcare sector are quite strong. The legal sector, a lot of professional services. Certainly, we all know about call centers and coding. That was very early. But I think a lot of the professional services, which has been a tough nut to crack, getting good productivity gains in the service sector has been hard for decades. And I do think AI is going to really chip into that. But of course, here in the US, with healthcare being such a large proportion of GDP spending, that's a very important sector to try to bring costs down in.
What about now that we've started to see some partnerships between the chat models and retailers? Have they started to see a benefit yet from those partnerships?
Well, we've seen some early indications from Black Friday data. There are reports out that traffic that was sent to retailers or traffic that was sent to websites from AI got much higher conversion rates into sales than traffic that came from other sources. So I do think that is an important marker that retailers are going to latch onto, and AI companies are going to latch onto as well, to say, look, this is working. This is targeting consumers or benefiting consumers in a way, because targeting consumers is another way of saying you're bringing the products and services that they really want to them. So I do think that we're seeing some early indications of that. Meta or Facebook is seeing early indications as well, but it looks like it's becoming more widespread, and I think that's positive for consumers and companies.
Okay, let's get to the Federal Reserve. I'm wondering what your thoughts are on the rate cut that many anticipate for December and looking forward.
Yeah, we do expect there's going to be a rate cut in December. We think there's probably a decent chance of one taking place in January as well. December was very much on the fence until the New York Fed president, John Williams, came out and said that he supports a rate cut. And of course, he's very influential among the voting members on the Federal Open Market Committee. And now the question, I think, is going to be when they do cut rates, which is very likely in December, what's the messaging going to be? And how much is the market going to latch onto that messaging? Of course, the Fed's going to talk about being data dependent and the balance of risks. But I think the market might even start to look to May of next year, when we do have a new chair of the Fed, and the chair is going to be appointed by President Trump and likely share some of President Trump's loose monetary policy, dovish leanings toward monetary policy. So the market might not be as sensitive to the messaging as it would otherwise be, but the messaging is still important.
Young-Yu Ma, I've got to leave it there, sir. Appreciate you joining us on the program. Young-Yu Ma is Chief Investment Strategist, PNC Asset Management Group. And coming up next, shares of Allied Properties moving higher following a distribution cut and some analyst upgrades. More in a moment. Urban office space developer Allied Properties cut its monthly distribution by 60% as the company looks to reduce debt. So let's get more from Brad Sturgis, equity research analyst of real estate and REIT, Raymond James. Thanks for joining us today.
Great. Thanks for having me.
Was this a must-do for Allied?
Yeah, I would characterize it as we were expecting a distribution cut. Clearly, they had telegraphed this as part of their commentary on their call the last quarter. We thought the payout ratio was at a point where a distribution was unsustainable at the current level. So, given where the stock had basically traded over the last several weeks, we thought a pretty material cut was already being priced into the stock here today, and ultimately we saw a sizable cut that we thought was in general pretty prudent, and where we kind of expected the size of the cut to be, to kind of right size the payout ratio, right size the amount of cash that they're retaining to start to repay debt and improve the balance sheet.
How deeply in debt is Allied?
Right now, the key metric we typically look at is debt to EBITDA, and debt to EBITDA is at a historically high level for Allied. They're running at, call it 12.5 times on that metric. They do have a plan in place to now retain more cash through the distribution cut, but more importantly, they do have some asset sales planned over the next few quarters into 2020, mid-2026, and then they could get cash back from some of the condo closings that are expecting at King Toronto. So there is a plan in place to reduce debt levels and try and get that leverage metric down, a few turns from, call it 12.5 times to call it into the low 8s. So there's still work here to be done, but we view the distribution cut as probably the most important first step here.
How much of a dent will this make to their debt?
Ultimately, it's more of a modest impact. That you're saving about $150 million of debt or cash each year. So that will help on the margin. What's really going to be more important is they get a couple $100 million in cash from condo closings next year, assuming that they can close units that have been pre-sold. And then the asset sales, we're expecting over $500 million of asset sales. So those are probably the more important factors. Plus, if there's a recovery in the office market and you start to see your EBITDA grow, that's also a really important factor here. So on the margin, I would rank kind of a distribution cut as a lower factor. I think there's kind of more important things we're now looking for to get the balance sheet back in better shape here.
Okay, so let me ask you, Brad, is it a bigger problem, the condo situation and those not selling, or is it a bigger problem, a return to office?
I would say the key factor for the stock over the last quite frankly, the last few years has been the return to office. Their occupancy rate has been trending a little bit lower. They're at 84% occupied at September 30th. They're kind of forecasting that to be flat for the rest of the year. They were highlighting or guiding towards 90% at the start of the year. So it's been a slower than expected recovery on the occupancy side. Ultimately, that's going to drive EBITDA growth way more than the condo component. They do have a little bit of exposure. It's one project. It's 90% pre-sold. So, it's something we think about in terms of risk profile in the short term, but ultimately this is an office landlord with, most of their cash flow and operations generated from leasing office space. So ultimately we view that as the most important factor in terms of better stock price performance and ultimately a better balance sheet going forward.
Okay, you mentioned that they do have to look at making some changes moving forward. Have they already been selling assets so far? Or so how successful has that been?
Yeah, so far they have started that program. That's been ongoing for most of the year. It's going a little bit slow. The type of assets they're trying to sell typically are lower density office assets that could have a future kind of development intensification opportunity. That market, just given what's happening with the condo market, is a bit slow. So that is moving, I'd say, a little bit slower than expected. And generally speaking, office transactions, we've started to see a little bit of green shoots on that front, but it's been slow for the last few years. So, we'll see how successful they are on that front. Certainly we are expecting asset sales to pick up, at least in the way we forecast it next year. But so far it's been a bit slow.
What's your price target for this point? Did it change after today's announcement?
Yeah, so we upgraded from a sell to a hold, so a little bit more constructive, but there's still, as we talked about, more things that we need to see here in terms of getting more constructive on the stock. We did take down the target from 14.75 to 14. So right now, we kind of see a little bit of upside. It does trade at a discount to NAV. It trades at a lower multiple, but I think we're being pretty cautious still on our stance in terms of the amount of time and the pace of recovery, let's say, on the office side. I think it's going to be a pretty gradual process here, and there's a lot of factors, as we talked about, that need to be executed before we probably get more constructive on Allied.
All right, Brad Sturgis is with Raymond James. Brad, thanks for joining us today. All right, coming up, despite an agreement between Ottawa and Alberta on a new pipeline project, a research from the Angus Reid Institute shows many Canadians do have some nervousness about lifting the tanker ban. Back in a moment. After strongly opposing the agreement signed by Alberta Premier Danielle Smith and Prime Minister Mark Carney on a new possible pipeline, the BC Premier David Eby has softened his stance. CTV's Colton Prale reports.
A new tone from BC Premier David Eby, who in an exclusive interview with CTV's Question Period told our colleague and host Vassy Kapelos that he's open to a new pipeline going through BC to the coast, so long as that pipeline doesn't require any changes or the elimination of the oil tanker ban. Now, that's not great news for Prince Rupert or Kitimat as options, but it does open up the Port of Vancouver, not just an expansion of the TMX pipeline, which he also says he would support and is in favor of, but a potential new pipeline following the same path. Ian Anderson, former head of Trans Mountain Canada, and Kinder Morgan, lots of experience in this area, also spoke with Vassy over the weekend, and he also highlighted the Port of Vancouver as an area that could be considered for a private proponent. Now, all of this is a significant shift in tone from the BC government, not just supporting the expansion of the TMX pipeline, but potentially another pipeline so long as there is not a direct impact on coastal First Nations. And this really paints a clearer picture for whomever the private proponent for this potential pipeline could be. It's a shift in tone from David Eby. It opens things up just a little bit, and it allows the project to move forward with a little more clarity in a way that it didn't have before. The big question is, what does Alberta think of this? For a long time, Danielle Smith has been clear she wants that pipeline going towards the northwest coast. We also know that there are a number of large companies who have been advising her in her push on this MOU, including TransCanada. And so while the economic concerns are very much up in the air, there is a new window being opened here. There is a new possibility. The other development in all of this is that as David Eby signals he may be open to a little bit of a new picture, we are still seeing intense pushback from coastal First Nations and from the BC Premier on their part. In that same interview, saying they view any changes to the tanker ban as an existential threat to their economy, effectively saying no risk is what they are willing to accept. There is no room for risk toleration. And so even as the conversation shifts to increased safety methods and potential for an area, for example, north of the Hecate Strait, in through the Dixon entrance, near Prince Rupert to be discussed, that the view from coastal First Nations is that that is still off the table. It's a clear portrait of what's needed for whoever this private proponent will be, what sort of consultations will need to take place, and where those consultations may go a little smoother than elsewhere. Back to you.
CTV's Colton Prale there. So what do Canadians think about this memorandum of understanding signed between Ottawa and Alberta? Angus Reid Institute decided to find out. Let's welcome Sachi Kurl, president of the Angus Reid Institute, for that. Thanks for joining us today.
Hey, thanks for having me.
So overall support for the pipeline potential is strong, at least at this stage. What was the number?
Well, there's the national number and then there's the regional number, and they tell a couple of different stories. I mean, in one way, you could look at the macro, the micro, and the super micro. At the national level, you talked about that strong support. 60% of Canadians say that they could support the idea of a northern pipeline between BC and Alberta. One that, even though David Eby talks about I could support a pipeline, just not with tankers, one does then wonder how the stuff gets out to the sea. However, in British Columbia, you see that level of support is at 53%. So it's a slim majority. It's just over half. It does represent a really significant change in the number of British Columbians who would support a pipeline project over the last decade. It used to be in British Columbia, opposition to something like this was really massive, and it really crossed the political divide. In BC now, what you see is there's a lot more support among right-leaning British Columbians, a lot less support, in fact, downright opposition among those who would vote either federally for the Liberal Party or for the NDP provincially. Again, that's David Eby's base. Now, when you look at the level of opposition on Vancouver Island and the North Coast, really that part of the province that would stand to be most affected by the potential of a spill, that is where you run into a brick wall of opposition. So overall, just because the country wants it doesn't mean that the regions in British Columbia that stand to be most effective are supportive. They're not.
Okay. So that makes sense when you parse it out that way. What do BC residents have to say about the tanker ban itself? Do some of them support lifting it for this project? What did you learn?
Again, you don't have majority support on lifting that tanker ban, except for in the parts of the province that are furthest away from the coast, so the BC interior, which tends to tilt more right-leaning in terms of its politics. However, you do see, there's about 40% who either say, overall in the province, who say, look, either make an exemption for this one project or lift it altogether. But if there is a hurdle to clear for Ottawa, if there is a hurdle to clear in terms of public opinion and public perception, it really is on the issue of that tanker ban, because in BC, overall, the majority view at this point is to leave that moratorium in place.
All right. You also looked at Canadian sentiment about foreign investment, and there's a lot going on here right now. What did you find?
Well, on that front, again, caution, I think, is the story of the day when we ask Canadians nationally, what are the two things that are, of these two things, which one is the most important to you? Is maintaining Canadian sovereignty over critical resources. So that's not just minerals, but it is things like oil and gas, it's things like potash and other critical resources. Would you prefer to see that sovereignty remain in Canada, even if it takes longer for private investment dollars to then be found to invest in the development of those resources? Or should foreign ownership be allowed? And again, here Canadians are really tilting towards keep that sovereignty. And, now we're talking about a lot of different resources, and we're talking about a lot of different companies that are vying for potential ownership. Obviously, we're talking a lot on your channel and in other places around, for example, the Anglo-Teck merger. Well, that's a British company. People are perhaps more aligned with, okay, if there is a situation where there is foreign ownership, some countries are more acceptable than others, but a lot of concern over U.S. Investment in critical resources, real concern over Chinese investment in critical resources, and overall, a tilt towards saying, look, if we're going to invest, they should be Canadian dollars.
Interesting. All right. Very enlightening. Always good to take the pulse of Canadians and how they feel about these big potential movements. Sachi Curl is the president of the Angus Reid Institute. Thank you for joining us. Appreciate that.
Thanks for having me.
Coming up next, big week for bank earnings in this country. We'll get more on what the expectation is when we come back. The holidays usually come with holiday hiring. Stores want to beef up their customer service at a restaurant. But how easy is it this year to find a job? CTV's Sarah Plowman went to find out.
At malls across Canada, people are hunting for a deal and some a job. Jaden Flexman landed her holiday gig at Hickory Farms, where she'll sell gourmet meats and cheeses into January.
It was a lot of applying online. There was about 200 online applications I'd done. if not more.
According to the job search site Indeed.com, holiday hiring is up 12% compared to last year, but companies aren't posting as many positions as they did 2 or 3 years ago.
There are going to be a few more options potentially out there. At the same time, job seekers are potentially competing with more of their peers.
Bernard says it's been a tough market for job seekers the past few years. Canada's unemployment rate is about 7%. The youth unemployment rate is double that.
To really get the labor market moving in the right direction, we just need a stronger overall economy.
To help keep up with holiday demand, Endeavours and ThinkPlay in Fredericton posted one seasonal job. More than 180 applied.
We have combed through all of those resumes.
People with retail experience, but surprisingly, a lot of nurses too.
A lot of the applicants I noticed, there were multiple current positions and they're looking for a second, a third.
In Brandon, Manitoba, Toy Masters brought on new staff, including students, but had to turn dozens of people away.
It really breaks my heart to see how hard it is for a lot of these young adults and kids to be finding jobs these days.
Come January, Flexman will have another job. She has advice for anyone searching.
Just keep in mind budgeting, and paper resumes do still work sometimes, so don't give up on those.
Tips to digest when there's no avoiding a challenge. Sarah Plowman, CTV News, Fredericton.
Canada's biggest bank set to report earnings this week, and despite the trade war and the uncertainty, analysts are expecting a boost for profit. For more on that, let's go to Paul Goldberg with Bloomberg Intelligence. Paul, thanks for joining us today. You expect, or there is an expectation of fourth quarter solid results from the banks.
Yes, thank you for having me. The expectation is for low double-digit growth in revenues for most of the banks. Net interest income should be able to hold up pretty well, even though the loan growth has been somewhat sluggish. The steepening yield curve is happening to keep the margins solid. On the fee side, the capital markets business and the wealth management businesses should still be helping those banks quite a bit.
Okay, what about an outlook for 2026? Do you think there will be some changes or some tweaks for the banks to their outlook?
Well, I think the banks are going to be quite a bit more cautious in terms of the outlooks because the loan growth is still kind of on the slow side and there is no tariff resolution in sight. So going into the next year, and obviously the fiscal year, we're already a month into the year, things are getting quite a bit still challenging in terms of the expectations.
All right. What about charges, potential charges for fourth quarter? What do you see?
I think most of the charges are going to be still heading slightly higher, particularly on impaired loans, as we still see some delinquencies rising to more normalized levels. The performing reserve probably going to stay relatively flattish in terms of the expectations because the commercial loans that typically drive a lot of the performing reserve, as I mentioned, there's still no quite clear resolution for the tariffs and there's still kind of negotiations are inside. So the commercial reserves are going to be, and provisions for those are going to stay elevated.
Interesting. All right, Paul Goldberg is with Bloomberg Intelligence. Thank you for sharing some time with us today. Oil prices are up today after OPEC Plus announced that it will maintain production levels during the first quarter of the next year. We'll talk about that in a moment. OPEC Plus will stick with plans to pause production increases during the first quarter of next year, with growing signs of a surplus in global oil markets. We got more from Gregory Rue, senior analyst at Eurasia Group.
OPEC Plus's strategy since April has been to increase production, to retake market share while slowly easing off the market management that it's been pursuing for the last several years. But lately, I think the members of OPEC Plus have grown a little wary of how much additional supply to bring on. They're conscious of adding supply too quickly. They don't want to push the market into oversupply. They're watching the nature of the supply-demand balance very closely. They're watching the forward curve, which remains in backwardation, suggesting there's additional space for more supply. hasn't yet flipped into contango. They're conscious of balancing supply with things like geopolitical risk, the ongoing Ukrainian attacks against Russia, a member of OPEC Plus. That's putting upward pressure on prices. So for now, there appears to be space for OPEC Plus to continue with increasing production. But for the first few months of 2026, they want to press pause. They want to see how the market's looking in the latter part of the year.
You, Gregory, I got to get your take on this. You just wrote an article in foreignpolicy.com, and the headline is Why Oil Sanctions No Longer Work. Can we switch over to that? So America talks about these, the Americans in particular, sanctions on Iran and Russia, but are they a blunted tool now?
Well, Andrew, it's a very interesting question. You know, on one level, sanctions do work as a tool for shaping markets. Iran is a great example. You know, the U.S. has had oil sanctions on Iran since 2018. And as a result, Iran can only sell to one customer, China. Now, they've had a lot of success. You know, in the last few months, Iran's oil exports have been moving above 2 million barrels a day. And that's the highest level of exports since sanctions were reimposed. But Iran remains constrained. Sanctions have forced them into this narrow channel. At the same time, sanctions are supposed to work as a tool for changing state behavior. The whole reason behind sanctioning Iran's oil exports is to convince Iran from ending its support for regional proxies like Hezbollah in Lebanon, to back away from its nuclear program, to stop developing ballistic missiles. Iran hasn't done any of those things. If anything, it's doubling down in the wake of the war with Israel that it fought in June. Flipping over to Russia, you know, the U.S. and the EU have been putting increasing sanctions on Russia since the invasion of Ukraine in 2022. Just a few weeks ago, we had the U.S. Sanctioning Lukoil and Rosneft. But again, the goal is to try to change state behavior. And nothing that I've seen from Putin suggests that he's going to pull back on his war in Ukraine. So in that sense, yes, the sanctions no longer work as they originally intended.
Where, if you had to, I mean, it's very hard to measure. I mean, the world burns 100 million barrels of oil every single day. But is it your read that a serious surplus is emerging in the crude market globally?
I think there is going to be a surplus. It's really just a question of how big and whether geopolitical factors push the market in the other direction. You know, in a way, the fact that, so many analysts, so many models are predicting a pretty significant surplus in the early part of next year, that's part of the reason why we're starting to see increasing geopolitical pressure. The U.S. sanctioning Lukoil and Rosneft, Ukraine attacking Russian export terminals in the Black Sea, and then apparently a couple of tankers over the weekend. There were reports that at least 3 tankers linked to Russia's oil trade were struck by missiles or drones. You know, this all stems from the fact that there is likely to be at least 1.5, perhaps even 2 million barrels a day of excess supply in the first half of next year. And that suggests that the market is soft enough to absorb additional geopolitical risks, to absorb additional supply shocks. So in a curious way, the imbalance in the fundamentals suggests that we have greater risk of geopolitical events with Russia, with Venezuela, right? There's increasing signs the U.S. might be taking action against Venezuela and potentially against Iran as well, right? The issue there around Iran's nuclear program hasn't been fully resolved. So while I'm conscious of the fundamentals pushing the market into oversupply and pulling prices down, I would encourage everyone to remain conscious of the geopolitical factors.
Yeah, Venezuela, I mean, it's kind of bizarre. America has been buying oil from Venezuela for years. And is it plausible that President Trump would actually launch military action against that country?
Well, Andrew, I'm always conscious of predicting exactly what President Trump is going to do. Okay. He is unpredictable. He's proven himself that. I would say that the U.S. is marshaling a huge number of military assets in the Caribbean. It's really historic. There's an aircraft carrier. There's at least 10 surface vessels. There are fighter squadrons. There have been attacks against these boats allegedly moving narcotics out of Venezuela over the last several weeks. The president is being somewhat cagey in his rhetoric, right? There was a call between President Trump and President Maduro of Venezuela about a week ago. But the signs all suggest that the U.S. is preparing to escalate against Venezuela. Whether it affects oil, that's something of an open question, right? To your point, Chevron remains active in Venezuela. The U.S. continues to take some Venezuelan crude, although something like 85% of Venezuela's crude exports go to China. Again, like Iran, it's constrained by U.S. sanctions. I think the U.S. has an interest, if it does escalate against Venezuela, in avoiding striking any energy infrastructure. let's say that there isn't a campaign against Maduro and it is successful, that there's some kind of government change or some kind of regime change. A new government in Venezuela is going to need oil more than ever. And if the government is supportive or friendly towards the United States, that means that the U.S. has an interest in preserving Venezuela's oil and export infrastructure. So I don't think the U.S. is likely to strike that infrastructure if it does in fact escalate against Maduro. But again, we'll have to see what President Trump decides to do in the next several weeks.
Time now for Hot Picks, and we looked at 3 stock plays in apparel with Zachary Waring, equity research analyst, CFRA, and we kick things off with his first pick on holdings.
A fast-growing footwear company, and they're also moving into apparel. We think the move into apparel will help growth over the next 3 to 5 years. But their footwear business is one of the hottest brands in the world right now. And we think shares are undervalued. They've fallen because of the tariff talk. They do most of their businesses in the U.S. right now. They do have a Europe business and an Asian business, but the largest part of their business is in the U.S. So they've been impacted pretty significantly from tariffs and the tariff talk in the U.S. However, in their last quarter, they actually saw gross margins increase pretty significantly too. So it kind of just shows their pricing power. And we really like the name. We think shares trade around 25 times forward earnings, and that's well below their 3-year average. We think this is an opportunity.
And what is distinctive about their clothing?
So their footwear, it's a newer brand. They're just doing a really good job in innovation. But I think in general, they're a really hot brand. People love the product that they're putting out. They look very clean and aesthetically pleasing. So, we think they're in the same ballpark as Nike in terms of innovation. They're doing a really good job there. But we just think shares are pretty much really undervalued here.
What about Abercrombie and Fitch? They have been in vogue lately.
Yeah, so, Abercrombie obviously had a really big pop after earnings. Shares were up 40% that day. That's continued over the next couple of trading days as well. And we still think there's plenty of value in shares. So, shares trade under 10 times forward earnings still. This is well below their 3-year average. Once again, this is another company that's been significantly impacted from the tariff. I think investors are really sitting and waiting to see what the actual impact of these tariffs are going to be over, a full year period. And you're just starting to get, some of the impacts. So they are seeing an impact, but they've been able to offset, a pretty good portion of the tariff impact. And I think, from a value standpoint, they trade under 10 times. I think their 3-year average is around 15 as well. So, there's significant value, I think, emerging in these shares.
And then finally, Hasbro, they do sell clothing linked to their toys, but it's not a big part of their business. What is attracting you to Hasbro these days?
Yeah, so the reason we really like Hasbro is their digital business. So obviously, most people know Hasbro from their consumer products division. So they sell a lot of toys. They're a toy manufacturer. But over the last 3 to 5 years, they've grown their digital business significantly. And it carries a much higher operating margin, 40% plus operating margin. So as that business has grown and become a bigger portion of total revenues, you've really seen their operating margins improve. And it makes them a little bit more insulated from some of the tariff talk and some of these tariffs that the new administration have put in. So, valuation is fair here. I think they trade about 16 times forward earnings, which is above their 3-year average. But before, 2019 and before, the company traded above 20 times forward earnings. So we think there's an opportunity here as investors kind of catch on to the margin story.
I'm sorry, what is their big source of profits, though, these days? Where would most of their earnings come from?
It's digital. So their digital business is driving, most of their profits right now, especially as their consumer products division or their toy division has faltered. And you've seen, big decline in their consumer products division over the last 3 years since COVID. The COVID highs, as you came out of COVID, they did really well. But since, you've seen a big decline. And we think as you turn the corner of the tariffs here in the next next year, in the second half of next year, you're going to start to see not only margins improve for their consumer products division and aid the digital products division, we think the revenues will also turn around.
Zachary Waring, equity research analyst at CFRA. Know Your Options is back Wednesday, 3 p.m. Eastern Time. To have all of your options trading questions answered by Chris Tom of Moat Financial, you can send your questions at knowyouroptions@bnnbloomberg.ca. That does it for the close today. Thanks for joining us. We'll see you back here again tomorrow.